Guys, we have 3 stocks trading at or near their 52-week low. And you know how much I love looking at 52-week low stocks. I say this in every 52-week low video. It's a great place to start looking for value. But remember, price is what you pay, value is what you get. Just because it's at a 52-week low does not make it a good buy. Stock number 1, Target. Guys, this company just plummeted today. They had a triple miss on earnings. They absolutely got demolished. Last quarter, they saw a significant drop in same-store sales. This quarter, they rebounded to a positive, but not as much as people would have liked. It is down 21%. Guys, 52-week high versus 52-week low. Check this out. 52-week high, 180. Low, 121 just today. Now, guys, I own Target stock. Do not buy a stock just because somebody on the internet has it, or even Warren Buffett. We're here to teach a process. But the thing I like about Target, you will see very shortly, I was buying it from 135 all the way down to 105, and I think it hit a low of like 103 or 101. So this company has a $57 billion market cap, 95 to 98 enterprise value. That difference is debt, and my guess is a lot of that debt has to do with leases, because this has a lot of locations. That's the biggest thing on Target. Pays a handsome dividend for those of you who love dividends of 3.6%, eating up $2 billion of their cash flow. Now, last 12 months, their cash flow is at $5.3 billion versus net income of $4.5 billion. Kind of nice here. Kind of nice. Profit margin, a little over 4%. Gross margin, 28%. So it's got about double the profit margin than Walmart has, but only a slightly higher gross profit. So they do a better job of generating profit than Walmart does. Now, let's check out the pillars on Target. What are our 8 pillars telling us about Target? Well, I don't really worry about this one. This is our debt level. Like we talked about before, a lot of their debt has to do with their leases. So I'm not as worried about that. Now, their cash flow is down with such a big increase in revenue, $22 billion increase in revenue in the last 5 years, yet cash flow is down over $1 billion. So something to take a look at, because net income's up $1 billion. So something I definitely want to, let's go take a look deeper into the cash flow statement and see why. Now, this last column is our trailing 12 months, but our cash flow right here, as you can tell, we're kind of on a big stretch of a big decline in cash flow over the last few years. But look at this last year, $5.3 billion versus the last full year of $3.8. So it seems to be back on the upswing, hitting $7.9 billion in the 1 year following COVID. All right, so this is probably a fluke. Hopefully. I did a poll on Twitter today, and I want to show you guys the results. Target just reported and it was really bad. They missed on revenue, EPS, and guided poorly. Is Target dead or dying, or is this temporary? 29% of the votes so far, 196 votes, only 45 minutes left, said that Target is dead or dying, 71% temporary. Guys, retail is tough, but I think Target's doing a good job. They cater to the right customer. That's women. Women love going to the stores. I like going to the stores. Now, the overall story on Target. Let's have a conversation about this. The recent earnings report resulted in that triple miss I was talking about. Target also lowered their guidance from a range of $9 to $9.70 per share to $8.30 to $8.90 per share. Comparable store sales were up 0.3%, but the expectation was 1.5%. And earnings per share came in at $1.85 versus $2.30 expected. That's a big miss, guys. Target has over 1,900 stores operating over 246 million square feet of space. They're the 6th largest retailer in the US by revenue and 3rd largest by volume, behind Walmart and Amazon. Now, guys, for Walmart shoppers, 60% of the time they're coming in for groceries, whereas in Target, only 22% of the time is it groceries, as most customers at Target come for discretionary items such as apparel, home furnishings, and decor, as well as appliances. This is also why they probably have a higher overall profit margin. Now, Target has gone through a few tough years with boycotts of the stores because of the LGBTQ product pushing. Luckily, Target has been able to pivot with the consumer, and the stores are beginning to improve. One thing to watch for Target is how the US consumer is doing. And today, consumer sentiment is trending lower, and US credit card delinquencies are on the rise, which could be the cause of the recent triple miss in earnings as the consumer gets weaker. Now, here's some good information on Target, guys. Digital comp sales have grown 10.8%. There has been 2.4% growth in traffic, which is equal to 10 million extra incremental transactions. And like I said before, overall comparable store sales have grown 0.3%. And they grew their Target Circle Rewards program by 3 million members. So guys, I asked the question, does it feel like this is an ongoing problem with Target, or does it feel like it's temporary? How do you have an increase in customers going to the store, increase in the rewards program, but a decrease in the stock by 20-some%? To me, this seems temporary. So what are analysts saying about Target? Now remember, analysts have their bias, but look at this growth rate they have for their earnings per share. $8.40 to $13 per share in the next 5 years. Let's go to revenue. Basically down 1%, down 0.5%, back to growth. From 108 billion to 126. And guys, I don't think Target's going to be a big grower on revenue. I think they're going to grow along with nominal GDP. So I think this might be actually a little low, in my opinion. Now, what does this all mean? Well, guys, for this stock and the next two stocks, we have a good story, or we have a story. Whether you believe it's good or not is completely up to you. What we have to do then is translate that story into the numbers. Every investment is the present value of all future cash flow. How do we determine that cash flow? Well, that's why we use our stock analyzer tool. We make our assumptions on revenue growth, on profit levels, on multiples and our return, and say, based on those, this is what price you should pay. So here are the assumptions I made. I did 2.5%, 3.5%, and 4.5% revenue growth. Guys, let me go a little bit more conservative. Let me go 2%, 3.5%, and 5% revenue growth. Profit margin, I did 3.75%, 4.25%, and 4.75%. Same for free cash flow. And my multiple. Guys, it has a pretty decent return on invested capital. Nothing to write home about. But if I asked you where the best place to shop these things, you'd probably say Target or Walmart or Amazon. So it's one of the big players. And they're doing a much better job of doing online sales just like Walmart and Amazon. So I did 15, 18, and 21. And finally, guys, I'm always doing the 9 or 10% return because even though you need a margin of safety, for here I want to look at what's the intrinsic value. Margin of safety means a higher desired return. So for those of you out there who have our software or are getting our software, make sure you remember that. This is not the correct number to put in. To buy an individual stock, you need a higher return. Or else I'd just say, why not just buy the market? So we hit the analyze button. The stock's currently at 122. We have a low price of 124, high price of 241, middle price of 175. Based on today's price and my middle assumptions, I'm looking at about a 14% return. Now, does that mean it's going to happen for sure? No. But if I had 30 stocks that had this potential return that were all Target size, I'd probably do pretty well in investing. Where would I go? I don't know, but it'd probably be a lot better than the market return. Stock number 2, ASML. ASML, guys, this company is involved with semiconductors. And look, it's actually down 1.75% today. All-time high, 1110, just back on July 11th of this year. 52-week low, today, 645. This is a drop of over 40%, almost 50% in the company right here. Why? Well, let's take a look. So first off, some metrics. Here's what I love, guys. $256 billion market cap, $277 billion enterprise value, basically $20 billion here. Actually, it's quite a bit because there we go. 5-year free cash flow, 5.72. So very reasonable. Now, here's one thing that's interesting. Net income last year, $7.3 billion. Free cash flow, $3 billion. Net income in the last 5 years, $6 billion. 5-year average free cash flow, 5.7. So these are pretty close, but the 1 year is a big difference. Let's immediately go to the cash flow statement and see why that may be. Let's see if they had a big increase in their capital expenditures. Okay, so 5 years ago, they did about $1 billion, $650 to $1 billion. Now they're doing $2 billion in capital expenditures. That shouldn't drive down the cash from operations, the big hit. Big drop. Well, because of semiconductors, it might be declining. All right, so here's the catch here. You've got big increases in cash from operations in the last, but then big surge during COVID. And it's just coming back down now. The question is, where is the stable level? Now, ASML, you might be able to consider the beating heart of the semiconductor revolution. The company holds a monopoly on producing extreme ultraviolet lithography machines, each costing over $200 million and taking a year to build. Now, these machines are indispensable for creating the nanometer-scale chips that drive AI, 5G, and high-performance computing. AI and 5G alone, guys, that is so important to our world operating. Now, with the semiconductor market expected to explode to over $1 trillion by 2030, ASML's technology is the linchpin of this growth. Over 100,000 components per machine make it irreplaceable to clients like Taiwan Semiconductor and Intel. Without ASML, our digital future wouldn't just stall, it might collapse, some would say. Now, whether I agree with that or not, would somebody else pick it up? Maybe. But these are the things being said about the company. Let's go check out the 8 pillars here on the company and see what it looks like. So guys, we're looking here at check marks all around except for the 5-year PE and 5-year price of free cash flow. But again, look at this return on invested capital. 20% in the last 5 years, 25% last year. Growing. So the question is, so this is the funny part. It's down 40 to 50%, and yet the 5-year PE is still low. Still very high, I mean. Why? I mean, guys, we saw it's coming down from its COVID lows, COVID highs of revenue and profit. Where's stabilization? Let's see what analysts think about that. Earnings per share, oh my gosh, massive growth. Look at this, $20, $32, $37, $46, $52. I hope these analysts are right, guys. Because if you can buy this company with this kind of growth rate and earnings per share, holy cow. Revenue growth, basically break even this year. Same growth, 32%, 9.5%, 15, 14%. So they're able to drive a lot of their revenue into profit as time goes on. So again, leads us to the question, stock analyzer tool. What should we assume for stock analyzer? And I did this back on July 15th of this year, ironically 4 days after their all-time high. 4 days after their all-time high. Now, one thing I love, increasing ROIC. The last 10 years was 14.5%. 20.5, 24.5. It's getting better as of late. Revenue growth. I did 6, 9, and 12% because I did a 10-year analysis here. I can understand somebody doing 5, 8, and 11. In fact, I think I'm going to do that. 5, 8, and 11%. And I'm probably being too conservative, but so be it. 22, 23.5, and 25% profit margin. 24, 27, and 30% free cash flow. Guys, these are probably low too. Well, maybe it needs to be a combination of these two. Let's actually make these the same. Let's call it this. Let's call it 22, 24, and 26. I could be wrong, but let's see how that goes. PE and price of free cash. So I did 15, 18, and 21. And then the 9% return. I hit the analyze button. Now, guys, this is why the software is so important. It's really, really important that you're able to do both the story and the numbers together. That's how you combine these. That's how you make great investing decisions. That's why thousands of people in our community are talking about ASML. This was the #1 stock requested by our community members to look at. Now, if you're not in the community, that's a tragedy. And you may have noticed if you've gone to the website to sign up, we have a daily number of users that we're allowing into the community and software. And the reason is today's software includes everything we have to offer for stocks, real estate, and retirement. But behind the scenes, we're making a lot of changes. That offer is going to go away very soon. Now, remember, from the very beginning of this channel, I built this software selfishly for myself. I had an Excel sheet. People kept saying, how do I get that software? How do I get that Excel sheet? We didn't have it available. It took a very expensive data feed, but it sparked the idea. Let's make this for people. Let's create that community because investing is so difficult because it can be a lonely road. We can get ourselves trapped into our own thoughts. It's nice to have thousands of people out there that we can talk to and bounce ideas off of and get new ideas from them. I use this software, my team uses this software every single day to make better decisions for stocks and real estate. But as we've grown, it's becoming less about me and more about how I can better serve you guys, the community members. And this is why we spend so much money updating our software continuously. Now, the good news is a lot of these major changes have not been made yet. They're still being worked on. So if you join today, you'll be grandfathered in for life with everything. And this is the best deal we have ever offered. So you still have time. So click on the link in the description below to get access to everything we have to offer. And I assure you, it'll be the best investing decision you've made all year. So I hit the analyze button. I have a low price of $275. High price of 640, middle price of 420. Guys, I'm just waiting on this one. All right, let's see. Let's make these higher. Let's say my conservative assumptions are actually higher. Let's say 8, 12, and 16%. It's still hard today at today's price. But I could be wrong. But I look at this saying, this is why I like the stock analyzer tool so much. I can sit there and see how far off am I. I greatly increased my revenue assumption. That still happened. Stock number 3, Enphase. Guys, look at this fall from grace. Enphase hit a high December 5th of 2022, almost 2 years ago, of $339 per share. 2 days ago, the low was $58.33. And it's currently at $62.76. Quite the fall. Now, if you look at Enphase here, area of concern, 5-year profit margin, 16%, 1 year, 5%. Why is that? I don't know. That's something to look into. All right, now let's take a look at the Enphase 8 pillars. So we have revenue growth of $530 million. Oops, wrong side. $530 million led to $120 million in free cash flow and drop of $116 million in net income. And one thing I do love about Enphase, if you look at this, free cash flow last year of $336, 5-year average of $439. Look at their net income, way lower. This is a positive. More free cash flow than net income. Eventually, those things will even out. But I love this situation. Their price to free cash flow, significantly lower than their net income, their price PE. Okay, so it's still a young company, but solar panels are still a young business. This happens to be an opportunity for a long-term multi-bagger. Enphase operates in that solar panel industry with specific operations within the inverter industry. The advantage to an inverter is it's cheaper to install, easier to diagnose problems as the inverter will fail rather than the panel itself. And they're cheap to repair and easier to repair as they have fewer parts. Now, a big reason a lot of people see that the price has fallen from over 300 is partly due to California's new net energy metering 3.0, which slashed the incentives to own solar panels by 75%. This matters because California is by far the largest install base for solar panels. And if they change their regulations, my guess is others will too. The new regulation pushed the incentive payback period from 4 to 5 year return upwards of 8 to 9 years. That's a significant difference in the return on investment. Now, Enphase and SolarEdge make up 95% of the entire global inverter market, with Enphase holding 50% and SolarEdge holding 45%. The company gets 60% of its revenue from the United States, and is in the process of building out a footprint in Europe, Asia, and South America. In addition, potential for income per home has grown to $12,000 per home versus $2,000 back in 2019. Another advantage that Enphase has is that even though Chinese counterparts make a cheaper product, due to national security reasons and geopolitical tensions, the US does not allow China to sell their products in the country. Yet, that is something that I want everybody to remember, that right now they don't allow it, but who knows what that means in the future. So let's check out the analyst estimates on Enphase to see where they're going. Look at this growth, from $264 per share to $950 per share in earnings per share. Now remember, free cash flow is greater. And revenue growth, a big drop this year, but growing $2 billion, 2.4, 3.15, 2.79, well into double-digit growth for the next 4 or 5 years. Now, another thing I want to look at, guys, is go back to the main page. 46% gross margin, 16% in the last 5 years, but those incentives have fallen. What's going to be the stable standing point? That's what's hard about this company right now. Free cash flow is significant. Look at this free cash flow. Let's go to a stock analyzer because it'll tell us the free cash flow margin. Look at this. Increasing basically in the last 5 or 10 years. Net income, much lower. So I'm going to focus on free cash flow here. I'm going to make my assumptions. Let's see if I've done Enphase in the past in our history. So guys, here's my stock analyzer assumptions. I did 10-year analysis. I did 6, 12, and 18% revenue growth. I did 10, 15, and 20% profit margin. But remember, I'm going to focus here on the free cash flow. Look how much higher that free cash flow is. I did 20, 25, and 30% free cash flow margin. And finally, I did a 15, 18, and 21 PE and price to free cash flow. Now remember, PE, don't worry about the PE. Focus on that free cash flow. Over long periods of time, earnings and free cash flow will be pretty close to each other. And of course, I did my 9% return, hit the analyze button. And guys, here are my prices. A low price of 34, high price of 161, middle price of 75. So it's in our green range here, getting you about 11% return based on today's middle assumptions and today's price. I have found so many great stocks when I look at 52-week lows. I have 3 more stocks to analyze with you that were trading near their 52-week low. Watch it right here. Thank you for your time.